Welcome back, folks. All right, so we're going to be doing a review on the video recorded Friday. I gave you both renditions of it. I gave you the sped up version where I condensed over 90 minutes of trading down to 8 minutes and 10 seconds. So it's there for both of the category of student you are. If you're real quick and you just don't have time to be being diligent about it and you're not here really to properly learn, you can be entertained by watching the short sped up version. For the ones that want to really learn what it is I'm teaching you here, I provided you the entire recording. So that way nothing is hidden. Everything as it occurred at regular speed. You can watch the fluctuations of the 15-second chart and the 1-minute chart respectively. I'm going to go over what the pre-trade analysis was. Okay, and I'll walk you through what I was observing and how everything should have panned out in addition to what I was executing on, which is obviously very salient and clear on that 15-second chart. So everything that I was annotating on the 15-second chart in addition to this. So I'm saving a great deal of extra stuff that I could make the video longer with. It's for those that want to study it. So that way you're going to compare and contrast what I'm showing you here. Have that also on your notes as you're watching that 15-second chart. If you take the levels I'm putting on here and you apply them to your chart and you watched what I did on the Friday PM session, you will have a better view, and a more comprehensive understanding about what it is I was doing. But this is the stuff that I tell you that is in my notepad next to me. I'm going to show you how I get the information and then how I use it, how I used it on Friday. And then once you have an understanding what it's likely to draw to and how it should behave, understanding real order flow, institutional order flow, algorithmic price delivery, all those components meshing and coming together perfectly, you have something in the hands that are capable. It looks too good to be true. It looks too mesmerizing. It looks too perfect. And it's these types of trades that have garnered me the label that it has to be delayed data. And I take that as a great compliment. I love that. I absolutely love it. Because if viewers are watching it and I leave them with no doubt, like I show everything that's possible, showing you that it's not market replay, it's not delayed data, everything's live. And for the folks that sit with me and watch me call out live price action in every individual 1-minute candle and sub 1-minute candle and how it should behave and where it should draw to next, it's not hard to see that the bridge is just the experience factor between when I'm executing and what I am teaching and when I showcase with real live tape reading in front of tens of thousands of people that are watching me when I'm live streaming. All right, so I started with a weekly chart. And Caleb, this is kind of like where we're going to take you to the higher time frame. So this week we're teaching how to find the setups, where the setups will form. So this is going to kind of like ease into that. And then later tonight, I will have Caleb's first video on his channel. So I'm going to be putting content initially on his channel. So it gives him a basis on what he should be doing. Because admittedly, from what I shared so far, he needs a little bit more clarification on what he should be practicing and studying and how to annotate his charts. So I will be doing some of those things each day, kind of like along the same lines of what I'm showing you here as a top-down analysis and annotation. You're welcome to use this one, okay, as a benchmark. Okay, but going forward, everything that is shown in the examples on Caleb's channel, it's better for you to go into your charts. And I know some of you don't have a lot of time. You're doing other things in the world. And you think that no one's going to know any different if you just screenshot my charts or his. You're not saving time. You're actually elongating the learning curve because it's these things that you should be doing in your own charts. And you don't know how long this is going to go on. And we could stop this at any time. So if you don't do it in your own charts, you haven't really equipped yourself to be able to do it without me or my son. And kind of that's the point of this, right? So that way you can do it on your own. So on the weekly chart, if you see what we were doing here, we had traded up here the previous week, and this is obviously showing what was now last week's trading. So this hadn't formed yet right when we were trading in the close of the previous week. So assuming that we were looking at the market last Sunday at 3 o'clock in the afternoon Eastern time in US. This is what the chart would look like. It would have this wick here, down close candle, long discount wicked candle to up close, large up close candle, smaller up close candle, and then we didn't see this start trading yet, okay, because the market starts trading and opens at 6 p.m. Eastern time. So looking back through this price action, I expect price to go higher. I've indicated this for the entirety of the month of August using the higher time frame. This wick here, we had closed prior to the week we just ended here. Prior week, we closed here, which is above this wick. So if we're going to go back down into some kind of a discount, we can measure this candle's high, that candle's low, and get an approximation of where the midpoint is, or consequent encroachment, because this is a buy side imbalance, sell side inefficiency. But if I have a candle like this that makes part of the swing low, I want to incorporate that wick, and I want to leave some of this down here open. So how far can a retracement go? Well, theoretically, it could go down to this candlestick's high, and that still would be permissible. It's likely, most likely, it's stronger, most bullish. Can I use any more adjectives to describe my thought process here? I want it to stay inside of this wick, not go any lower than the open of that candle. Now, we're trading down into this candlestick with last week's trading. So if we highlight that range here, I'm highlighting the candle's high and the open. So the open of that candlestick and the high. That is the entire range. So I'm treating it like a gap, just like this would be reasonably expected to see it trade back down into it. But we aren't trading with myopic perspectives. We're looking for very specific algorithmic principles that are going to repeat, that have to have some measure of logic behind them. Otherwise, you'll be trying to capture every little fluctuation into an imbalance or inefficiency, thinking it must close there. And that is the difference between what I teach and am actively teaching versus everybody else there that thinks they understand imbalances. So the candlestick's wick here, because we opened up here last week, that makes this wick a discount array because it's below where we opened. So how far can it trade down? It can trade down to this candle's open right here. So the entirety of that wick's range. This opening price is an order block because of everything I just said. It's not just simply because of the down close candle. Everything a part of it. It's a swing low. We closed above. We opened. We're above this wick. This imbalance, it'd be better if what? If it leaves the lower half open. So it can trade down into this wick here and touch the opening price, which it does efficiently, and it does go past this a little bit, but not much. That is a mohawk. It's something that is not perfect, but it's something like your child just coloring outside the lines of the coloring book page. You're not going to reprimand them. You're not going to say, look what you did wrong there. You're going to hang it on your refrigerator. You're going to take it to work with you. I use this analogy all the time. So when the algorithm is repricing just outside the lines that you think would define perfect price delivery, you can't assume that something's broken. That's actually what you want to see. You want to see it made an attempt to get below. And did it accelerate going lower? No. Okay. So with this framework here, we're going to start fleshing out some more information. So here's half of that wick. So that price is 19,440.50. That is consequent encroachment of this wick. Can it trade below that? Yes. But if it does go below it, we need to start seeing some measure of immediate rejection. It needs to show strength. It needs to be able to quickly get out of that area and not lay around in there a lot. Just, it can go down below it, but it needs to reject it and start working towards the higher half of that wick, as we see here. So I'm drawing your attention into this. So while, yes, we traded down to the opening of this weekly candle, we hit the order block, we went to the low of this wick when we opened up last Sunday, traded down to it, but now my attention is here inside of this portion of price action, defined by this candlestick's high and the midpoint of this entire wick. So what I'm essentially saying is the bulk of what I intend to do trade-wise is going to be better suited in this blue shaded area. Even if I do get something on a long down here, that's fine, but it doesn't require me to absolutely get something down here. It gives you flexibility, basically. The best trades will be down here, but the more opportunities will be up in this blue shaded area. Okay, and it'll make more sense as we drop down. So these are all things that are expected. We want to see how we open up on Sunday. I never know where we're going to open up on Sunday. No one is going to know where we're going to open up on Sunday. But that opening defines our new week opening gaps. So are we opening up a higher than where we closed the previous Friday? Or are we opening lower than we would close the previous week's Friday? And that defines our new week opening gap. You don't define your new week opening gap on weekly charts. You don't do it on a daily chart. You do it with a 1 minute chart. Okay, so this wick shaded area here, just keep that in mind. And that blue shaded trend line is that opening price on a opening price for a down close candle on the weekly chart. All right, so now we're into a daily chart. And here, this blue shaded area, that is where I want to be doing the bulk of my trading. If it can trade back down into that weekly order block, which is again defined by that blue line here defining the order block from the weekly chart, it should go down there briefly, not do blocks and blocks and blocks and blocks and blocks of price action like this. It goes down, yes, and comes right back out. That's exactly what you want. So on a higher time frame, that indicates that we potentially may be going higher. And until we start seeing evidence that it's not the case, then we stick to a mindset that it's going to go higher. So we look for buy signals preferably. Doesn't mean we can't look for shorts. It just means that the majority of our leverage should be allocated to longs and not to the shorts. So we have a buy side and balance, sell side efficiency here. We'll comment on in a second. But this low here, watch this here. That low is 19,100.50. That low is 19,140.25. That makes up a volume imbalance. So on the daily chart, and again, you can keep track of my charts up here. It's the daily chart. So we have a volume imbalance. And I already know what you're thinking. I already know what your questions are going to be. And I know what you're asking right now. And you want to know, can you just talk about, and I'm going to talk about it, trust me, in a minute. Here is our buy side and balance, sell side and efficiency. Here. So it's defined by the candle's high, that candle's low. So that makes this a fair value gap. And it's categorized as a buy side and balance, sell side and efficiency. It's buy side and balance. It's inefficient in sell side until we get this and this candle. And then it's done both up or buy side delivery, which is simply the movement of the price going higher. And then sell side delivery, where price is offered to the downside to a previous imbalance and inefficient level, which is defined by the single candle right here. That is the high of the BISI. This is the low of the BISI. It trades down to it, to the order block. And how far can it go beyond that weekly order block price, Michael? Well, look what the daily chart's offering. You have a volume imbalance right here. The market opens here on Friday, creating a volume imbalance there as well, which we'll comment in a moment. But it opens and trades right back down to the previous close. So this makes this an immediate rebalance and then sends it higher. I promised I told you I'd answer your question. Why sometimes your chart looks like you have the settlement price toggled on your daily chart and then sometimes it's not. For the last time, I've said this a few times now since I started teaching about it. If you notice that the daily chart is showing that little blue SET, that's saying that your settlement price is being used on your daily chart. Right now, notice that it's toggled blue. So my daily chart right now is blue SET. So it's toggled, okay? Notice that the volume imbalance between this candle's close and this candle's open, that volume imbalance is what I'm highlighting there. That volume imbalance between this candlestick's open and this candlestick's close, that's a volume imbalance, okay? Watch what happens when we look at it when the SET is not toggled. So now it's black. So it looks like this. The volume imbalances go away. I've indicated this before. If there's any widening between the candlestick bodies, if I'm toggling back and forth, I'm doing both settings. I'm toggling it on and I'm toggling it off. When it's not toggled and highlighted in blue, it'll look like SET in black, like you see down here. The volume imbalance disappear by contrast. Now, with it toggled on, again, it's blue. The volume imbalances appear again. I want to be able to see if it looks like this at any time between the two choices. If I ever see a volume imbalance with one toggled on or off, I'm going to elect to use the one that has the volume imbalances. I want to see the separations because that separation is going to highlight an imbalance or inefficiency, and I want to know what they are. Before TradingView, I was looking for things like this anyway, and you can do them manually. Like you literally can do it without having any requirement of toggling that settlement price being used on your daily chart or not. You're just looking at the times that the candlesticks close versus the end of the trading. And they make it very plain. If you're toggling your chart each day, as soon as the day ends at 5 o'clock Eastern Time, New York local time, go to your daily chart and show what it looks like when we close. When that candlestick closes, that's your levels. Toggle it back and forth and make sure that you see if there's any volume imbalances. If there's a volume imbalance, that's the setting I'm going to go with. If there is no volume imbalance, I'm not using that one. Okay. You'll see over time that that's what I'm doing. If you go back and look at old examples of me either giving analysis or trading, unless there's something that is extremely much more important that I'm trading around without using that information, I'm usually using the logic I just shared here. Okay. So Tuesday's candle from last week here, that's what I'm highlighting. I want you to look at the low of that candlestick right there. That low comes in at 19,441.50. Now, I taught that you have to start using old daily lows and old daily highs. You want to look back at the lows and the highs of the last three candles. So if we're going to trade on Friday, as you saw me do, here's Friday. Look back 3 days. Thursday, Wednesday, Tuesday. See what that does? It affords you several days to refer back to old levels. Now, when we're opening here, are we requiring any necessity around the high of the previous? It can be used, yes, but more closely related to the open on this Friday's trading to Tuesday's low. See that? When we were trading here and we closed right here, before we opened up there, This indicates that what level are we looking at? Is it closer to the previous day's low where we settled here, or Tuesday's low? So which one's going to be a more of a impactful price event? More likely to trade to, basically. Clearly Tuesday's low. Okay. Now you can have all of the highs and the lows in the last 3 days indicated in your chart, and you'll watch how they gravitate towards them. Okay. But don't think for a second just because you have the last 3 days high and low toggled on and shown on your chart annotated, that it's going to be easy read for you to get to it. You're going to have to rely on other things I've taught. But if you do these things, you'll see, Caleb, that it goes right to the most obvious one. It'll go the path of least resistance. Okay. And it's going to many times gravitate to these levels. The reason why these levels are important is because large institutions, banks, big conglomerates that have deeper pockets than you and I ever will, they have lots of orders that they intend to trade the market at those highs and lows because there's an enormous pool of liquidity around them. So if you use these levels predominantly in your trades or frame them as your trading model or where it's going to draw to, you're going to have the best of the best type trades. The cream of the crop, the easiest ones that go real quick to these levels, and many times they're going to perform with low resistance liquidity run signatures, meaning that they're going to be very easily traded to. They won't hem and haw. They won't consolidate a lot before they go to the level you're aiming for, because the intended purpose is the algorithm will reprice to these levels because it understands that there's lots of buys and sells around them. It's not the buying and selling pressure that takes them to these levels. It's the fact that there's lots of pending orders below old lows and above old highs. So it doesn't need to know how many orders are resting there. It doesn't understand that. But it does know by its coding to drive into those price points quickly, not just drift down there and bleed down to it. Many times you'll see them accelerate quickly and you'll see large range candles and jump right to the liquidity. So if you have these levels in mind as the basis for where the trading is going to reach to, or your setups are framed around, you're doing exactly as I'm teaching, because I'm trying to teach you to be a low resistance liquidity run trader that targets obvious huge pools of liquidity, and your trades are more likely to see little resistance. And that's exactly what every trader wants. They want to see movement. They want to see speed. They want to get their targets hit and be done. Get out of the trade. You know, the longer your trade takes to pan out, the more mental capital you're expending. All right, so we have the volume imbalance here. Open, trade down the previous candlestick's close. That's immediate rebalance. And we're trading below Tuesday's daily low of this candle at 19,441.5. So just remember this level here, 19,441.5. That's that low right there. So think about what we've done. We have traded down, redelivered all of this inefficiency. So buy side imbalance has been balanced with a delivery of sell side. There's no longer an inefficiency with price not coming back to overlap all of this up close candlestick between this candle's low and that candle's high. It's delivered here. So when it leaves what? This candle's low. We're back above it here. It comes back down just to overlap this volume imbalance between this candlestick's close and this candlestick's open. That blue shaded area is what's the volume imbalance. So it opens this day on Friday, trades down, that's the Judas swing, and then rallies up. So the price here that defines that buy side imbalance, sell side inefficiency, notice the high. It's 19,447.50. Tuesday's daily low is below that. So we're focusing primarily on Tuesday's low. Why? Because the daily lows in this instant is the most salient point to be watching with price. And I gave that level to you earlier in the week with this idea in mind. So these levels were in mind before the week started. Everything that's here until Tuesday's low was formed, I was referring to that candlestick's low right there, and that candlestick's high, and that order block level, and that volume imbalance. because these levels were in play. That means they were in the chart before we started trading on Sunday last week. That's why when I tell you I have a notepad with levels on my chart, it's these levels here. Then what I'm doing is I'm watching price real time and I'm seeing where are we at real time in relationship to those price levels that I have on my notepad. You're used to seeing them on my chart. I prefer them not to be on my chart. I want my chart clean. But you, while you're learning, it's beneficial for you to have them on your chart, Caleb. It's not something that you probably will keep forever, or it might be. I don't want to talk you out of it, but if you think it's helpful to you by having them on the chart, then by all means keep them. And then this up close candle here is a bearish order block. It's a propulsion block because we have the highest up close candle here. As soon as we cross below it, the opening price there, that makes this candlestick validation of that bearish order block. The next candle, we open, trade up into this one. So it does not completely close over top of this one, and the bodies don't close on this candle above midpoint of this higher order block. That makes this a propulsion block. Propulsion blocks are explained in month 4 core content. You can find that in the 2016 ICT mentorship playlist for month 4. There's a video lecture about propulsion blocks in that segment of the YouTube channel. So the opening of that candlestick is the bearish order block. So the propulsion block becomes a target. While we're below it here, it's going to reach up into it. And that's one right there. So we also had this wick here that you can break that down in quadrants in addition to, so they're all potential targets. So again, as these individual new daily candlesticks form, you have new PD arrays that you have to incorporate. But starting with a higher time frame, weekly and daily, from the previous week, you have key levels already that are useful. Notice that we're opening in the lower half, okay, the lower half of that larger weekly inefficiency. Remember, I cut the weekly wick and used the upper half of it. That's what that blue shaded box is here. Rewind the video and you'll see what I'm talking about. The very, very first thing I started talking about when we annotated the weekly chart. This is all of a weekly wick because it's going up here and going right back down. Half of that wick, the upper half, is what I'm going to be focusing primarily on because there should be a lot of sensitivity on all discount arrays in this blue shaded area. If I'm really right on side, if I do believe we're going to go higher, the best buys that really punch, really deliver off of the discount arrays are going to be in this area here once we get back into it. I afforded the market to go down that far, but it needs to only go down there quickly. 1-2 days, bang, up here we are. Okay, so let's continue on. We're dropping down to a 15-minute time frame. You can keep track now over here or watch in the upper left-hand corner. So here is the market activity. The levels I had annotated before I sat down Friday just passed at 2 o'clock. I was trading the PM session. I was trading a turtle soup setup, and I was looking for a rally higher, and I wanted to see if we could reach up into the bearish order block, which is what you see here. Because it was a holiday Friday weekend, in other words, Friday wasn't a holiday, but we were going into a long weekend. So Monday we have in the United States the Labor Day holiday. So that's going to impact volume. It's going to impact the times that we trade. It'll cause a little bit of a hiccup in cleanliness for price. So that's why I like to trade on Wednesday. So it gives me a day after the holiday on Monday. Let the markets do whatever they want. I can miss a move that takes place on Tuesday. I don't care about that. And then Wednesday, we'll be back to the swing of things where everything is normal. But what we're looking at here, we have a 15-minute time frame. Everything that was on that previous daily chart, and go one more time. This volume imbalance and this volume imbalance and this larger shaded blue area, those 3 reference points, okay, we'll see those here. Here's that larger shaded blue, the smaller volume imbalance, and the lowest volume imbalance is over here. So we're watching price Friday afternoon as it's dipping down here. I'm looking at how price traded below that low here, rallied back above, and we caused ourselves to see a breaker form. But I want to be trading at Tuesday's low or lower. Why? Because it's an old daily low. I can't get back to Thursday's daily low, but going back 3 days, that's Tuesday's low. That's why it's on my chart. So I want to be in there buying that. Let's zoom in a little bit. Same chart, 15-minute time frame. We have several things here I want to take your attention to. When we were dropping down here, look real close. See that wick? Now, come on, Michael. You're just picking things at random. Go back and listen to my live streams. I'm pulling out very specific things. And the recordings I did with Twitter, which is now called X, but I just refuse to call it X. The Twitter spaces I did where I would literally call out individual candlesticks, or I would tweet about individual candlesticks. So I'm taking your attention to very specific ones. Why am I selecting this one here? Because this one went down deeper than the previous one. See this one here? Yes, that's a wick, but this one did more damage. It went lower than this one. So it went a little bit lower into that daily volume imbalance. So when we start going higher, which we see it doing here, I want to see, does price drop back down into that Tuesday's daily low, and does it go lower? Yes. And I'm keying off of that consequent encroachment of this discount wick. Why is this wick a discount wick? Because price is up here, dropping back down into its range. That's what makes this a discount array. Look at the sensitivity of it. Look at how price delivered on Friday's trade, where I got in at. So I want you to be mindful of that. And we're going to walk through this entire thing here. Notice also, when this candlestick started trading right here, from this candle to the left, all of these candles were hiding nothing from you. Nothing was hidden from you. So from this low to this candle's high, we have all of this range to work with. So now, imagine you're a rock climber, and this is the sheer rock side that you have to climb up. What handholds could you map out as you climb back up in price? Which reference points here are you going to use, and then later also expect to use as a foothold? If you were a rock climber, and we're going to personify price as a rock climber, you, okay? How is price going to use all of these candlesticks here to get back up to a level of significance? A premium price, a higher price. You need not get up to this high. You don't need it. But you can frame out something here using Tuesday's low. What would you use? I'm going to walk you through it now. Typical buy side and balance, sell side inefficiency. Framed by this candle's high, this candle's low. We trade down into the consequent encroachment of that wick, and we leave what open? The lower portion. There's an opening left. See that? We want to see that. That is algorithmic. That's the hand at the card table being shown to you, saying, here's my cards. That's what the algorithm's doing right there. That's not buying and selling pressure. Okay, it's the algorithm indicating, saying, we're going to leave this inefficient because it's going to quickly run higher. This down closed candle, once we overtook it there, that makes this a bullish order block. The price on that candle here, we open, we trade down to this candle's opening price. The opening price of that down closed candle here is 19,466.75. This candle, we open, trade right down to it perfectly to the tick, and then it starts the rally. You can check that right here and see that that low of that candle, that's what I'm highlighting here. That's why you can see that candle, 2:15 p.m., Friday, August 30th, 2024. That candle, that low matches that opening price, and you see it there. Okay? That is perfect. That's not buying and selling pressure. Okay? So we're seeing price deliver, and then boom, there's an order block. Respects it, sends price higher. Then we have a fair value gap. Same thing. Do we have that candle's high to that candle's low? Do we have the entire fair value gap closed in? No. Is it indicating that the markets want to go higher? Yes. So now, from here, we have something higher than that we have to work with in this range over here. What is it? Sell side imbalance, buy side inefficiency. But because we're bullish, we're expecting this to be used as an inversion fair value gap. So this is a SIBI that we expect to see become a bullish discount array. So the market's going to trade up into the higher portion of it, trade back down, hit the fair value gap. Do we see price going higher? Yes. And then comes right back down to what? Consequent encroachment defined by that candle's low, that candle's high. What else is existing around consequent encroachment? What's this? The candle that opens and drops down into this fair value gap here and then sends price higher. What is that now? As soon as this candle goes above this opening price, what does this candle trading above it indicate this is? It's a bullish order block. But this drop down into it there is occurring in the upper half of this inefficiency. We want to see strong indications that it wants to repel away from any discount array in this area because it's now becoming an inversion. So we are not looking for or requiring it to get back down the lower half again in here. It's already done that here. If it would have been straight through and came back down to there, that's the same thing I'd expect here. I wouldn't see it come back down here. I wouldn't require that. Huge, huge thing there for your notebook. So we have the bearish order block here in this price swing, the opening price, that's the target you're reaching for when you're below it. And the market trades up to it here. Wonderful. Drops back down, gives another opportunity to reaccumulate around that order block there, and then trades up into a premium wick consequent encroachment there, and ultimately up to the daily bearish order block, which is what I indicated when we were in the daily chart. And there we have the delivery. So I want you to think about what is being shown here and rewatch the long version of Friday's trade. Now, I already know about 98% of you are not going to do that. And that's why there's going to be 98% of you that's going to feel like there's still something being hidden from you. ICT's hiding something from you. I'm not hiding anything. Everything I've used here in annotation was the logic that I was referring to in price action with my notes. I had all of these levels mapped out. So as price would breach the levels I needed to see breached going higher, everything that I'm annotating here were just simply numerical values written on my notepad. But again, like I said before in the past, when I was on Twitter, I could show you my notepad and it won't help you because you have to sit in the charts with me to go through all the levels and why they're pertinent. That's why everybody that bought my leaked core content lessons and my old 2016, 2017, 2018, 2019, 2020, 2021 mentorship videos, when you buy those videos, you're not learning it properly because you have to have me explaining it to you. It's just the language being introduced. That's why the people that buy those videos thinking they're going to get the secret sauce, I'm doing the secret sauce right now. I'm doing it right now. This is mentorship. So I don't do private mentorships where you can buy into the group. Okay, that's gone. I'm teaching for free here. So when I have my notes in front of me, it's all of these levels here, all these as they're forming. I'm writing them down on my notepad. But there's also new PD arrays forming on that 15-second chart, and I want you to look at where they behave in your chart. Now, obviously, if you watch this months from now, you're not going to have the advantage of doing that. You're going to have to really refer to the video that I recorded, which is why I gave you the long version of it. You can see it, it's clear, and you're encouraged to do it each time I show you an example. That's why there's no talking. That's why there's no music. It's just simply me showing you what I did. Then you go back through the price chart and you find all the PD arrays doing it like I'm showing you here. You're going to do this every single trading day for the one market that you're following, not 12 markets, not 15 different Forex pairs. You're looking for one market to follow. While you're learning how to do what I'm teaching you to do, we're using one instrument. It's NASDAQ. But I don't trade NASDAQ. I don't care that you don't trade it. Everything that I'm teaching you works in everything else. But you have to stick with one thing. Keep your mindset. You're all hurrying to try to trade. You want me to talk about your favorite market so that way you might have a hunch or an unction to be a buyer or seller, and you want me to confirm what you think might happen. Then you're going to over leverage your account and you're going to lose. And you're going to blame me because you did something wrong. So unless I tell you otherwise, everything I'm teaching you works in every asset class. So now we're dropping down to a 5-minute chart. We have a wick here. That's a discount wick when we're here. So when we drop down into that 15-minute fair value gap, let me go back up one more chart. That's this area right here on a 15-minute time frame. That's what this chart is here. We're going to go into that same area here on a 5-minute chart. But look at that wick right there. See how the bodies stop? So yeah, we drop down into that because there's a 15-minute fair value gap, which is why you have to constantly scroll through your time frames. Even if you have a laptop, you have to have these reference points. Because if you don't, you won't be able to see how price is delivering algorithmically and institutional price delivery. It's not as easy as you want it to be, clearly, but it takes time looking at it and taking screenshots like this. At the end of the day, go back through your price charts. I'm going to be building my son's initial library with today's presentation or tonight's presentation, introducing his model conceptually. And then every day I'm going to be reviewing the market like this. So you're going to see annotations. I want him to get used to seeing these because this is how I expect to see his charts. So he needs examples like this. So I'm showing it with my Friday trade, and then I will be doing it every single day, Monday through Friday, for, I don't know, maybe 3 or 4 weeks or so. And then we'll start seeing him. But it's giving you all and him a chance to see what it is that you should be annotating. And in the beginning, you're going to miss some things that I'll have in my chart. You may have other things that is pertinent to your model. That's okay. But I'm showing you how you are going to graduate in your understanding. You're going to get better at doing this because before you watch my review videos that's going to post on Caleb's channel, you should be doing this. And it'll allow you to check yourself. You're not sending me your charts. Please don't send them. I already got people sending me stuff in email. I'm not going to look at your stuff because I don't have the time to do it. And imagine everybody doing this. I would never be able to get anything done. I do have a life. So on a 5-minute chart, you can see all the same levels being utilized here. And the consequent encroachment of this wick here, the bodies keep that at bay. And everything here now, the order block. So we went below the 15-minute order block. That little mohawk outside of that upper portion of the sell sign of balance, buy sign of deficiency. That mohawk is simply just digging into that order block that you can see on a 5-minute chart. And we have a real nice delivery higher. My trade was closed here manually on that last one. And I was doing a lot of the things I taught earlier in the week last week, where I was showing you how if you don't know how to take partials, the easiest way for you to start getting better at it is simply trail up however many contracts you want to take off as a partial when it's trading in your direction. Let the market come back and stop you out on that number of contracts, and you'll still leave a portion of the position open. I was doing that in Friday's trade to kind of give you an illustration of it. I got a lot of feedback from that. People were like, well, I'm glad you did that because now it makes more sense. I can see it, and it's neat to see how it happens. But eventually, you'll be watching when price is reaching for this level here, and you'll have your limit orders resting above levels like this order block that was on the 15-minute time frame. You'll have your orders resting up here in the premium consequent encroachment of that wick on the 15-minute time frame. So as it reaches up to these extreme levels, that's where you'll be taking your partials. But until you get good at that, it's just better to have a trailing stop loss with a partial waiting for the market to kick you out. You won't get the higher exits, but that's okay. Taking partials when it starts to turn back again on you, the times that you do see it reverse entirely over top of what your existing open position still has open, The fact that when it does that, you'll feel better that you did it versus not knowing how to do partials at all and seeing a good trade turn into a losing trade. That's very demoralizing. So I'm coaching Caleb and I'm coaching you that are watching on how you can manage all that stuff. Okay, whenever you have a real good runner open and you've made profit, never let it turn into a losing trade. Never, ever, ever. Never, ever, ever. If you have a position that has 25 to 30 handles in open profit, that better never turn into a losing trade. It better never do that. So your stop should be covering costs by then, and or you have managed a partial, so that way if you do get stopped out, it doesn't take away the net result covering the costs and there's no loss. So I'll leave that up to you with your math and what size of account you're trading with for that to work itself out. But this is the backdrop behind everything else that was being shown on that 15-second chart. Obviously, on the 15-second chart, there's a lot more PD arrays, but I'm watching everything that I showed here in relationship to this drop down here. All of that buying in that big blue shaded area, this is all part of being part of that larger weekly wick, the upper half of it. And notice how it had real strong sensitivity off of every discount array. Every single thing that would cause the market to go up as I teach it, it used every single one of them. Not one of them failed. And the ones that were there, they many times indicated like it didn't close in that entire fair value gap. That's exactly what you want. That's exactly what you want. It didn't even get down to mean threshold of the order blocks. That's exactly what you want. It's showing every indication that this thing's going to go higher, and it's really being driven hard. So all these targets should be met easily, and we have it. And finally, we have our last chart here, and I have an error on here. It's driving me nuts here, but we're going to show how Michael's getting better with his obsessive compulsive disorder. It is not a 5-minute chart. Check yourself up here. It's 1 minute. Okay, you can see all the delivery here. The immediate rebalance, the daily volume imbalance, we rallied up, the fair value gap, go back through the higher time frames. And then when we drop down into that right there, when I'm buying that, it's occurring between 150 and 210 macro. Look at that beautiful delivery right there. Boom, right at the low. 2 o'clock. Rally. In here, we have an order block. Opening price hits it. That's one that could be utilized. Here. That's one also at the top of the fair value gap that's shaded in green. That's another entry. We have a fair value gap right there. An order block hits it. That could be another entry for you. This is again all in the 1 minute chart. And then we have the order block here that was on a higher time frame chart, and then price rallies up. We trade through the 15-minute fair value gap. We form that. We drop down again. You can see how we leave the lower portion open, and we drop down a little bit in the 250 to 310 macro, and it's just a time when the market will spool and run for liquidity. What is it reaching for? Trailed stop losses below relative equal lows and into an inefficiency fair value gap on the 15-minute time frame. When you drop down your lower time frame charts and you're annotating, it's real important that you indicate what time frame these arrays are. Like this is the daily volume imbalance. Why? Because I can tell right here with the label. If you don't label your PD arrays from the higher time frame when you're working your way down, you won't have the understanding when you look back at them months or weeks later. Because you're going to refer to these things and you're going to study how price behaves. And you're also using them on a day-by-day basis. So you're going to refer back to certain things and certain times of the day. So the market rallies, and 315 to 345, we have the market drop back down into a 15-minute bullish order block. And then we have the order block here, rallies during the market on close macro, which is 3:45 to 4 o'clock. And then we have the settlement macro, which is the last 10 minutes, which is 3:50 to 4 o'clock. And there's your macros. It's for the people that want to know what they are in the last hour. That's what they are. Last hour's trading 3 o'clock to 4 o'clock. That's what these are. Okay. And the market starts to spool aggressively. It trades into the premium wick consequent encroachment and then the daily bearish order block, delivering beautifully there. So that's the business. That's the markup. And you want to use everything that I have here and go back through the chart that I was using on the 15-second chart. Use the video at the original regular pace. Watch what I'm annotating on the 15-second chart. Everything that's shown here is in support of that. So I'm working from a higher time frame down to a lower time frame. That's the price delivery continuum theory. Using the order flow from the higher time frames, how everything should support itself. Discount arrays should send price higher. They should be breaking through premium arrays. Premium arrays should not be offering any resistance when you're bullish. Discount arrays should not see their halfway points traded to, ideally. That means bullish order blocks should not even see their mean thresholds be traded to. Fair value gaps or inefficiencies should see the market leave the lower portion of these inefficiencies open. They can close, but as soon as they get down to the lower end of it, they got to immediately reject out of that and come out of it quickly. They cannot be spending a lot of time inside that. That's institutional order flow. That's how you read it. You don't need depth of market. You don't need all the mechanics of having volume bars horizontally on your chart. You don't need VWAP. You don't need any of those gimmicks. Okay, everything is happening because of time, clearly as you can see here, and price. I'm telling you what the PD arrays are going to be, so that's the price aspect. The time that the market's going to behave a certain way, that's what I'm indicating here. Okay, so hopefully you found this one insightful, and I will talk to you again later tonight on Caleb's channel.